Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to finally generate some income for Rebecca Park and her Relic Spotter company. We're going to go through a number of revenue and expense transactions in the Relic Spotter case and see how they performed the last 6 months. Without further ado, let me turn it over to the narrator.
In the prior video, we did the first 14 transactions for this startup company. We will resume the case with transactions related to revenues and expenses. Some of the transactions will be summary entries to record 6 months' worth of activity. As we did last time, we will record journal entries and post to T accounts for each transaction. After each transaction is read, you should pause the video and try to do the journal entry. Think about 1. What accounts are involved? 2. Did they increase or decrease? 3. Do we debit or credit? Then, resume the video to see the answer and the explanation. In a search for new revenue opportunities, Park initiated an unlimited rental arrangement with the Penn Antiquities Club on the 1st of December 2012. Under this arrangement, the club paid Relic Spotter $1,200 cash upfront for unlimited rentals over the next year.
Okay, the journal entry for this one, we are receiving $1,200 of cash. Cash is an asset. We increase an asset with a debit, so we're going to debit cash, $1,200. Now we have to think about what's the other part of this transaction. So we're getting the cash, and now we're obligated to provide rentals over the next year. That obligation is a liability, and it should be something called like unearned rental revenue. Liabilities are increased through a credit, so we're going to credit unearned rental revenue to recognize this liability or obligation for $1,200.
When do we get to recognize the revenue? We have the cash. We have committed to allowing the club to rent units whenever they need them. Isn't that enough to call this revenue?
No, committing to providing the rentals is not enough to recognize the revenue. We have to earn it by delivering the service. And in this case, we deliver the service by providing the rentals over time. So we're going to have to wait until time passes to earn this revenue and be able to recognize it on the income statement. Then we need to post this to T accounts. We finally get another debit in the cash account now that we have cash coming in from running the business, and we create the liability unearned rental revenue.
For the 6 months ended the 31st of December 2012, rental revenues on the metal detectors total $124,300. Most of the rentals were paid in cash immediately. However, as an initiative to reward repeat customers, Park allowed a select number of frequent renters to charge their rentals and be billed later. As of the 31st of December 2012, $4,200 was outstanding under this plan.
Journal entry for this one. So there's really 3 accounts involved here. We've got rental revenues of $124,300. We have accounts receivable of $4,200. That's the money owed to us by customers for services that we provided. And the difference between those two, which is $120,100, is the cash that we're receiving. So we're receiving cash. Cash is an asset. We debit cash to increase it by $120,100. The accounts receivable is also an asset, also going up, so we're going to debit accounts receivable $4,200. That's what our customers owe us based on providing the rentals, sending them an invoice for the cash. We'll eventually collect that in the next couple months. The last part of this is we're recognizing revenue on the metal detectors. Revenue is a credit balance account, so when we increase revenue, we credit revenue. $124,300. It's going to increase revenue, which will in turn increase stockholders' equity. So the other way to look at this is this $124,300 of revenue $120,100 of that came in cash. The other came from providing the rentals and giving an invoice. Hasn't come in cash yet, but instead it's an accounts receivable, which will hopefully soon turn into cash.
Same question as before. What happens if we don't collect the cash?
Same answer as before. For now, we're going to assume we will collect this cash. Later on, we'll make an estimate of how much we wouldn't collect, and we'll create an allowance for that, which will reduce our income and reduce the amount of accounts receivable we expect to collect. So just hang on for later in the course. Then to post this one, we have another debit to the cash account, another increase in cash. We create an accounts receivable account with a debit balance, and we create a rental revenue account, which is both a revenue and it's going to be part of stockholders' equity. That's why I've listed both. Has a credit balance, and we increase it with an initial credit.
During the period between July the 1st and December the 31st, Park purchased $40,000 of sundries inventory, of which $38,000 had been paid in cash and $2,000 was still owed at December the 31st.
Journal entry for this one, we are paying cash. Anytime we pay cash, we're reducing an asset. We reduce assets with a credit, so we credit cash $38,000. We're receiving inventory. Inventory is an asset. We make an asset go up with a debit, so we debit inventory $40,000. The last part of this is the $2,000 of inventory we've received but not yet paid for. If you recall a prior transaction in the case, when we owe money to a supplier for getting inventory, we call it accounts payable. Accounts payable is a liability, so we increase the liability with a credit, $2,000, and our debits equal our credits.
We're cool with this one, but thank you for checking.
No problem. Happy to hear it. We need to post this transaction, so we have another credit to cash. We have another debit to our inventory account, and a credit to accounts payable, which brings the balance up from 0 to now $2,000, which is what we owe our supplier at this point.
Relic's botter recorded sales of sundries totaling $35,000 for the 6 months ended December the 31st, all received in cash.
Journal entry here is very straightforward. We're receiving cash. Cash is an asset. We make an asset go up with a debit, so we debit cash $35,000. Since we made a sale, we've delivered the sundries, we've gotten the cash, we get to record revenue. Revenue goes up through a credit as a stockholders' equity account, so we credit sales to increase the sales revenue by $35,000.
We are not cool with this one. Where is the inventory? If we sold sundries, or whatever you call them, then our inventory should go down.
Excellent question. This journal entry is only going to deal with the revenue part. We're going to record the revenue and the cash we receive from the sales at the selling price. We'll deal with the inventory part in another transaction in about 15 seconds. Post this to T account, so another debit to cash, our cash balance goes up, and we create a account called sales to keep track of the sundries, create that with a credit balance as a revenue account.
The original cost of these sundries was $30,000.
So in this journal entry, we take care of the inventory piece. So if we sold sundries, our inventory is going down. Inventory is an asset. We make an asset go down with a credit. So we're going to credit inventory for $30,000. Our debit here is going to be something called cost of goods sold, which is an expense. This is what we call the product costs that we recognize as an expense when we make a sale. So the inventory, the original cost of the inventory is the expense, cost of goods sold, that we're going to match up to the revenue that we got from selling these sundries. So debit, cost of goods sold, expense $30,000, credit, inventory $30,000.
Do these last two journal entries always have to go together? I mean, anytime you record revenue in an entry, do you have to record COGS in another entry?
Please also tell me why the revenue and the COGS were different dollar amounts.
Yes, these two entries are like the salt and pepper of accounting. They always go together. Anytime we sell goods or inventory, we have to make two entries. One to record the revenue and the cash that we're going to collect at the selling price. The other to record the reduction in inventory and the cost of goods sold expense or product cost at the original cost. And we hope that the revenue is greater than the cost of goods sold, because then we've made a profit or a markup on our product. If that's not the case, if they're the same or revenue is less, then you don't have to worry about doing these journal entries much longer. Then we post this by reducing our inventory account. We recognize a credit in our debit balance account, which is going to reduce it. And we create a cost of goods sold expense account, also part of stockholders' equity, with a debit.
Finally, Relic's Bottas 2 employees were paid wages of $32,000 total during the 6-month period, and Park drew a salary of $50,000.
Finally. I think the word, finally, may be my favorite word in the accounting language.
Haha, just try to do the journal entry. Journal entry here, we pay $82,000 in cash. Cash is an asset. We credit cash for $82,000 to reduce our cash balance. Paying our employees is a period cost. So since they work for us, we're going to recognize that as an expense right away. Expenses go up with a debit, so we debit salaries and wages expense for $82,000 to recognize this expense. Post this one to T accounts. We have another credit entry to cash, and we create another expense, salaries and wages expense, with an initial debit balance. These are all of the transactions that we're going to do for Relic Spotter during the open of their business. So now it's the end of their fiscal period. We close the books to transactions with outsiders. The next step is to do an unadjusted trial balance to make sure that everything we've done so far in our posting has been okay. I'm going to just show you quickly what this looks like. Not something to worry about. You're not going to run into it a lot in practice, I guess, unless you become an accountant. I've been showing you the T accounts one by one, but here's what they would look like all on the same page. You notice there's still some empty T accounts here. We've got more transactions to do, so we're going to fill those in as we go. But for each T account, what you want to do is draw a line at this point and calculate the balance. So we have $79,000 of cash, $4,200 of accounts receivable, $12,000 of inventory, $2,000 of accounts payable, and so forth. Then you carry all those balances over to another spreadsheet where you list all of the accounts. You have columns for debits and credits, and then you just list whether it's a debit or a credit balance. And as you can see at this point, when we add it up, we have debits of $536,500, same amount for credits. So we know that we've done everything correct so far because our debits equal our credits. And we can go on to the next step in the accounting cycle. Wow, there's nothing more thrilling than watching someone work through Excel on a video. Sorry about that, but that seemed to be the only way to really communicate this part of the accounting cycle. Plus, if you're going to learn accounting, you got to see some Excel now and then, right? So in the next video, we're going to work on adjusting entries, which is going to put us one step closer to finally putting together the set of financial statements. I'll see you next video.
See you next video.